Good afternoon, ladies and gentlemen, and welcome to the Trinity Exploration and Production full-year results presentation for the year ended 31st of December 2019. Before we begin, I'd like to submit the following poll. For your information, throughout this presentation, investors will be on listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand side of the screen. Please simply type in your questions for management to review. The company may not be in a position to answer every question it receives during the meeting itself. These will be available on your Investor Meet Company dashboard post that. Finally, we'd like to remind you this presentation is being recorded. I'd like to hand you therefore over to Bruce and Jeremy of the Trinity Exploration Production team.
Thanks very much, Paul. Good afternoon or good morning, wherever in the world you are. First of all, thank you for taking the time to join us. We live in strange times and this is all quite new to us, so please bear with us if we have the odd technical hitch. We're spread wide and thin in terms of bandwidth on our various networks. But first of all, welcome to you all, and I hope that you're all well and safe and your families are too. Obviously today we're presenting the 2019 results, but I guess all our lives have been dominated by the effect of COVID-19 over the last couple of months. Obviously the global economy and pertaining to us particular, the oil price. We've got a pretty tailored presentation to give you, which is around the kind of immediate response to an extremely low oil price that spiked, as we all know, negative last month. It seems to have settled in the mid-20s at the minute, but to describe Trinity in the context of that low oil price, and then to look at the medium and longer term prospects that lie in front of us and how the current situation has affected us. By design, we've built Trinity over a number of years to be a very low risk vehicle and a resilient vehicle. And so by having such low costs and low break-evens, we're more resilient to downward spikes like this in the oil price than many companies. And 5 or 6 years ago, we went through a pretty tough patch. So we learned how to manage our treasury very carefully and how to run our business sensitively and leanly. So today, we are still working at full pelt. Production is about as high as it's been for 5 or 6 years. So we're in pretty good shape. We're not standing still. We'll go on and show to you, what we're doing. While we're producing every day, we are working hard in the background to build options for us. So as things improve, we've got a differentiated story and a very profitable business still and a great platform upon which to build. So we're in a good steady state. We've got all our staff working. COVID has not affected us too badly. I'd have to say our staff in the field, when this whole thing broke, we were all worried as individuals, but they've been really a very brave bunch of men and women, 120 plus, go into the fields in South Trinidad every day with their full PPE and have been working extremely hard. And that's, you can see with the results of the current production levels. So we're fine as we are. We've not had to make any cuts or redundancies or salary cuts. And we look at costs very closely on a daily and monthly basis. And as you'll see, we've managed to take our break-even cost from $26 down to just over $20 for the rest of the year. And we can do better as well as we move forward. So with that brief introduction, I'll let Jeremy go into the first slide.
Thanks, Bruce. And good afternoon, good morning. Well, just moving to slide 3 in the presentation. Hopefully everyone can see. I think what Bruce described there as that forward, I'd like to continue in, and it speaks to this first slide in terms of building a resilient business through capital discipline, low operating break-evens, and innovation. In terms of the financial aspect of this business, for those of you who know Trinity, who have followed Trinity or looked at our results today, you'll see that the 2019 results are very much in trend as in terms of the direction of travel that you would have seen over the past few years. So coming back to where we would have been in 2016 and 2017 and the lessons we learned there, it's something that we've taken forward into the business model and have maintained throughout in terms of break-evens that are sub 30 and in terms of increasing profitability. And we'll show some trends later on as we get through to the other end of the presentation. But certainly in terms of our balance sheets, quite strong, no long-term debt, no senior debt. There is working capital debt that we drew on April the 2nd, very much as a precautionary measure, as at that point in time, the situation was more volatile than it is now. But certainly in terms of, as Bruce said, targeting to lower break-evens even further, to secure the business, secure the cash position, and generate operating cash flow as far as we can. And when we look at the forward curve that is currently in front of us, we think that the business has a good chance of continuing to generate cash as the oil price trends between $25 to $30. Capital efficiency, in terms of what we are currently looking at and the projects in front of us, we have pared away what one may call discretionary capital expenditure, and we are focusing on capital expenditure that we think are key to the business, and those will involve continuing with our recompletion programs. The recompletion programs, as you all know, or may have heard, when we go into existing wellbores and move away from the initial completion zones and move uphole where they stack reservoirs and produce from those uphole reservoirs, it is a lot cheaper in terms of the actual activity set. The payback periods are quite quick, and it is a relatively low risk from a reservoir perspective standpoint. We have been pursuing these RCPs since 2017, come forward in earnest, and in fact, we are one of the most active recompletion operators in Trinidad. In fact, probably the most active recompletion operator. So it's projects like those that will keep production stable, bearing in mind that if you do not touch production and you don't add new oil, that production will tend to decline. The RCPs is what we think will support a stable production as we aim to end this year somewhere within the range of 31 to 3,300 barrels without actually deploying CapEx to drill. The other aspect that we'll be deploying CapEx will relate to the asset integrity. So where we have issues within assets and we need to ensure that our people and the environment is in a safe manner, we will take those projects on. We don't anticipate significant spend there, so we think that the spend in terms of CapEx should be in or around, from a point forward basis, from April go forward, should be in or around $1.5 million on a low side. So we should have roughly between $3 to $4 million of CapEx on a low scale, but we have the opportunity to also to pare that back should the oil price move in a direction that we are not comfortable with. I think underpinning everything is the operational and HSE performance. Certainly the financial metrics that you see coming out are a result of the operational day-to-day decisions that are taken by the team on the ground. And as a result, the financial metrics that you see for 2019 have been quite buoyant, and we'll get to that on the next slide. But certainly it's key to understand that being able to generate these results on a year-on-year basis for the last 4 years means that the operations and HSE in particular, that aspect of the business is in good stead. And it continues to grow and get better with more and more transparent HSE reporting and operations in terms of the complexity of the jobs and the repeatability. We are getting more and more standardized and therefore assuring the business. I think that is the underlying trend that we'd like to get, and we'll speak to deeper on within the presentation as we illustrate that the trends that you have been seeing, we are working on ways to actually further improve upon them in terms of step changes. And in fact, try to get better at what we do as we focus on trying to scale this business, which is the ultimate goal that we're pushing forwards to. I'm just moving on to the next slide. The next slide has some data points in relation to the 2019 results and the mix of operational and financial highlights. In terms of the financial highlights, certainly we grew production year on year by 5%. Revenue grew as a result of that, but in the backdrop of a slightly muted oil price. So the oil price year on year was down, but because of a lower operating cost than the previous year, the profitability rose by 14%. So EBITDA, adjusted EBITDA, which adjusts for non-cash items such as share option expenses, actually grew year on year, and on a per barrel basis went to 34%. So cash operating costs down, operating breakeven down. In terms of these KPIs, certainly the board and management, those are KPIs that we look at on a monthly basis, and we try to ensure that these are in the right levels, and certainly the direction of travel that we're seeing is comforting and encouraging for us, particularly in this unprecedented scenario that we're seeing with the virus and the oil price. In terms of some of the activities, we drilled 6 wells last year, so 6 onshore wells, and that came on the back of drilling 8 wells in 2018. That 6 plus 8, 14 wells. Certainly when you look at the Ministry of Energy statistics as posted up on their website, and this is the Trinidadian Ministry of Energy, that places us as the most active driller in Trinidad and Tobago for development wells, bar none. So you look at the other international oil companies and other public operators, Trinity has been the most active in the space of the amount of wells drilled, as well as in terms of the recompletions, as I mentioned before. So we are a very active investor. And whilst we've seen production grow, certainly year on year by 5%, I will just cast back to 2017, where we ended that year with an annual average of 25.42. And the current Q1 production in 2020 is actually 32.91. And for the 4 months, 33.18. So it's roughly about 800 or 900 barrels increase in terms of where we are, representing roughly a 30% increase in production in 3 years' time. So a lot of investment that has paid off in terms of the production, and with an underlying business that is built to be profitable. Certainly it leverages greater operational cash flow. We within those 6 wells last year, we drilled our first high angle well, and I will allow Bruce to speak to that later on. But that high angle well was drilled on time. In fact, it was drilled 1 day less than planned. In terms of the subsurface perspective, it came in as planned, and we intersected the oil sands as planned with slightly better than anticipated net oil sands. And in respect of the production, the IP of the well came on, north of 100 barrels per day, which is exactly what we had planned for. We continue to work with the well and try to understand it better, but the results have been very encouraging. And the next time we resume a drilling program, you will see high angle wells start to come into play more. And of course, now is not the right time to deploy capex to drill wells, but certainly we've got that on the burner, and the team has that ready to go in the background. Aside from that, we also did a Scada trial, and Scada is supervisory control and data acquisition, and it's part of us digitizing our oil fields in part of an overall initiative to digitalize Trinity, so to pull us into the 21st century and be prepared to try and future-proof the business from a data perspective, from an automation perspective, technology, and skill sets for our human resource. We did a Scada trial on 2 wells in September and October of last year. Those trials gave us results that were very encouraging in terms of what the technology could do. And we actually saw, we got a welcome surprise with production from the wells that we trialed were, greater than we anticipated. So the Scada, what it really does is it automates our response in terms of tuning a well. So each well has to be produced at a certain rate, and that rate changes on a daily basis, or even more frequently than that, depending on the downhole conditions, depending on the mechanical conditions, depending on the artificial lifts. And what this does is it allows us the opportunity to understand what is happening with the mechanical side of the artificial lift process, and then tune the well accordingly to be able to try to adapt as best as we can. It essentially speeds up our response time significantly, from days and weeks to seconds and minutes. And it allows us to get better and better at what we do in terms of stabilizing production. And in some instances, as we've seen in the trial, it actually increases production. I would caveat at this point, and we get into a little bit more, that Scada needs to be, we will explain it a little bit further, but it is not a case of one size fits all, which we'll describe a little bit more in detail later on. Moving across to the next slide. This slide further deepens the discussion around the financial performance, and we've got the looking at the operational aspect of the business. You'll see on the top left-hand side where we've red boxed the 2019 performance as it relates to OPEX and G&A, and you can see that in both, the OPEX certainly on a comparative is down considerably by more than $2, and the G&A up slightly by 10 cents on the dollar. But net impact is that the reduction in the OPEX has driven a much higher increase in profitability when compared year on year. And that is really what is driving the EBITDA change. That is when we compare 2018 to 2019. Down below that, it focuses on what the operating costs or the operating break-even changes are, and you can see that the East Coast leads there. So the East Coast operating break-even went from $26 to $22. And that is driven by the amount of and types of workovers that we had on the East Coast. We actually had less workovers than planned, and the types of workovers were not in relation to the expensive electronic submersible pumps on the back of us trying to get more cleaner current and cleaner power supply for the ESPs. The ESPs seem to have responded well to that. Certainly, I mean, these are pieces of equipment and they all will fail at some point in time. But what we managed to do is stave that off. And of course, the fewer you have, the less frequency we have with these types of workovers. It's the cleaner and cleaner that your earnings become. The East Coast, as a reminder, or for those who are not familiar with us, the East Coast has actually is a pilot or a representation of where we've taken automation and seen it succeed. So the East Coast, the majority of wells that are out there are on some sort of a surveillance system with supervisory control as well. So we've taken that approach, we understand it, and hence why we're now rolling this out to the onshore fields. On the right-hand side, we have a graphic up at the top that attempts to illustrate the hedging strategy that we have. And hedging is something that we implemented in 2017 to protect the debt repayment that we had on balance sheet at that point in time. But as we cleared off the debt in 2018, we continued with hedging, mainly to try and mitigate the impact of a tax called supplementary petroleum tax. We put a couple of hedges in place earlier this year when the oil price spiked, and the oil price would have spiked for a matter of minutes, and we managed to have the correct market orders in place, and those were filled. And rather fortuitously, with where the oil price has gone and where the forward curve attempts to be, these hedges will actually provide us with material income over the course of 2020. So we have roughly about 38% of our production hedged with three instruments. One is a put spread, and the other is a put spread with a collar, so a three-way in essence. These were put into play for 2020, and the intent at the point in time when they were put into play was to continue to hedge on a rolling basis. But the market has changed significantly right now. We are reassessing our position, but the intent is to continue to utilize hedging as a financial tool and a key to our overall financial strategy. Bottom right-hand side, the graphic there just illustrates the operating break-even and the adjusted EBITDA in comparison 2019 to 2018, both moving in the right direction with the operating break-even going down and the adjusted EBITDA going up on a per barrel basis. Moving on to the next slide. Sorry, one further. Next slide here, and the bar graphs on the left-hand side is what we are attempting to simply illustrate what will happen with cash across a broad range of oil prices in relation to the operating arm of the business. So just to be clear, the blue part represents what the cash would be as a factor of 1, and then the gray or the yellow represents what would happen to that cash balance if the oil prices, as represented below, were to play out for the next 8 months. So this sort of attempts to illustrate what could happen to our cash balance from an operating perspective. When I say from an operating perspective, prior to any capex. So if the oil price was at $15 a barrel, you'll see that we would have to eat into the cash balance, and we would not accrete cash in a scenario like that. But that does not also contemplate us as a management team and a board making decisions to mitigate that to the best of our ability. And as you move through from 15 going across the curve, you can see that from $20 go across up to 50 or 1. And the reason we use 50 or 1 there is really to illustrate the impact of the supplementary petroleum tax. You can see the business will generate cash from a very low level in terms of the oil price moving upwards. So we think, looking at the forward curve where we're at, it stands to reason that the business should be generating operating cash flow throughout this year. The reason that we showed the 15 and to point to the risk scenarios that we'd have done as part of our going concern assessments and getting our accounts in good shape, the management and board would have put together a risk scenario that contemplated an oil price of $10 flat for an ongoing period. We also contemplated risking, and just to be to give you a bit of a reference, the oil price at $10 flat is somewhere around 60% of a discount in comparison to the forward curve. So very, very, very deep discount. And we also risk production, and we also contemplated that we had to repay the CIBC facility for the 2.7 working capital. So we put all those things together, and we ran a cash flow forecast, and we actually illustrated that up to 15 months outward, the business would still be in a solvent position. I think the cash would be deteriorating, certainly, and whether we could sustain any more shocks would be questionable, and hence why management's view is written as it is per the accounts. But we also think that such a scenario is quite extreme, and if the oil price was holding flat at $10 for a protracted period, that there would be a wider existential question around the overall oil industry, supply chain, economies, and so on. So this is really to illustrate to you that how resilient the business is and the ability to accrete cash across a broad range of oil prices, starting from a relatively low oil price scenario. The next slide, I will start off and I'll then hand over to Bruce. This pyramid in front of you, starts at the top with, if I have my CFO hat on, speaks to results and the financial impact of what we are trying to do. But if I'm looking at it from a managing director and looking across the entire organization, it starts at the bottom from, having the right technology and tools and using those in terms of automation, and then driving that to change the way we do things through changing processes and managing our wells in a different basis. So we have looked, we understood that there's technology that we can use. We saw it on the East Coast where we deployed it there. We've then taken some of those same principles and trialed it on land in reference to the Scada trials that we did on land, and saw, promising and encouraging outcomes from that. We've now taken that on a wider scale. We've implemented it, Scada, on 6 other wells. So those are in play. But in learning and implementing that, the team internally has developed a much wider understanding than just simply going to a provider and asking for a solution. We have actually developed, come up the learning curve. We have in-house experts in relation to automation and artificial lift, and they're actually directing us in terms of how we can be even better at that and get more fit for purpose systems and modular systems for the different types of wells we have. So we operate roughly 284 wells. So for ease of numbers, let's say around 300 wells. Each well there is not equal. They're not all the same. They don't produce from the same reservoir. They don't have the same productivity. So we have tiered our wells and ranked them from tier 1 through to tier 5. So as Bruce likes to say, there's a premiership, and there's also, we come down to sort of the Vauxhall League in terms of, the types of wells. And each well will require its own type of solution. And we've looked at that now, and we've determined, there's a better economic way to approach this. There's a better data way to approach this. Not every single well will require supervisory control. Some will require data acquisition only. But what it does is, one aspect is the data and the tools and the processes, but it also creates an opportunity for our team, both operators and engineering, to learn and understand and get more up to speed and future-proof themselves as well as it relates to the industry. So there's a significant part of this that relates to people. So the initiative as it relates to automation, digitization and digitalization of Trinity is actually galvanizing everybody as we take a deep dive into understanding our business. And the landscape as it currently stands, just to remind you, is that we are one of the lowest cost operators, probably, in terms of lifting costs. Certainly when we look across AIM, we are quite low. And if you look across within Trinidad, we are very low. There's certainly, I think the closest that we see in terms of any published numbers is probably about 40% higher than what it costs us to lift. So what we are doing here is actually, yes, we're already in a good position, but we are looking within and finding ways that we can actually focus in onto key areas, which are people. So your labor force, which is a very significant line item in your operating expenditure. And the other aspect that we're going to focus in on is workovers. So workovers are something that we do in terms of reactive maintenance. So well goes down, we go in and we then repair and get the well back onto production. What this automation allows us to do is be able to actually predict in some instances so that we can stretch failures out. And as I mentioned before on the East Coast, is when you stretch failures out, one, you defer production loss, so your production is more stable. So it appears that you've got more barrels across in a shorter space of time. That's definitely what happens. But you also then are in a position to predict and plan for when you do your job. So the interruption time is very low. So in essence, you've changed your plant capacity, if I was to use a process plant analogy. And given that we are trying to really get a manufacturing business going on the onshore, it allows us to create a business that is even more efficient than it is now in terms of technology and wells, but as well as people in terms of upskilling them and moving them from your base operators or gauges and moving them into electrical and instrumentation technicians, different areas of technical expertise. So we think it's been a really interesting journey so far, and it's managed to bring everybody together. And coming back to where Bruce spoke about earlier, production is very buoyant at the moment, and we are very labor intensive. And within an environment where there's a lot of volatility, a lot of unknowns and uncertainty, to see production up where it is right now, in that 3,400 range, to me is a reflection of the underlying energy within the business. And perhaps I'll hand over to Bruce to continue after that.
Yeah, hi. Back in here, unmuting myself. Yeah, thanks, Jeremy. I don't know if I've got much more I can add. You've covered it from top to bottom, but this has been at first it was an exercise. I was visiting some Argentinian technology, and the founder was showing me their Scada system for measuring all over the globe, their systems and operations, and it was unbelievable. And when I started telling the guys in Trinidad about this, just at the same time, Weatherford came in, which is a big American service company, was talking about their Scada systems. And we put the two together. So one of the great things about this, which Jeremy was talking about, is that we've now got this on 8 wells. Not all wells need it. Some wells just need data measurement. Some wells need actual variable speed motors. And what that does on a variable speed motor is the well sends a message to the control panel every 11 seconds of what the inflow performance of oil into the wellbore is. And every 11 minutes, it makes a decision if it's going to speed up the pump or slow the pump down. This does many, many things. It obviously produces more oil for you. As Jeremy's pointing out, less workovers, so less cost on that well, so a greater NPV to the well. Less visits to the well, so less CO2, less pickups, less fuel, and less, strangely, in this COVID environment, less people-to-people, interaction. So the Trinidadian team and the head of artificial lift has really taken this and run with it, and it's a vein of gold within the company, I think, taking us forward, but also for the energy that it's brought to the entire operations. And what we do in Trinity, when there's a problem, say there's a COVID outbreak, or if there's a problem, or not a problem, here's SCADA and automation, how we can do it. We put together people from all parts of the company, from human resources, accounting, modeling, operations, whatever. And in this one is interesting, in automation, pretty early it came up that there'll be some HR issues to deal with here, is how can we reskill? So our great guys that work in the field, they've been working there most of their lives, and not make this frightening, but let's reskill them and say, you're going to be a better operator and you're more marketable. And actually, so that in their back pocket of their coveralls, it's not a wrench they're carrying, it's a phone or a iPad, and that's where the data is downloading to. So it's had a wonderful galvanizing effect. But the bottom line is, with all these things, is the finances and the economics. But the umbrella over all of this also is environmental and social governance. So 4 or 5 months ago, that's all that was really being talked about pre-COVID on oil and gas companies. Now, we have a responsibility, one, I think, to maximize recovery in all the basins that we work in the world, on behalf of citizens and governments and our employees and shareholders. But we also have one, we all know that, to transition fuels and transition our businesses. And we are one of the few companies in Trinidad that has measured their CO2 output. And we are now building a more comprehensive series of layers in our business that measure a lot of environmental and social governance type data. But we're kind of unique as a small oil company down there doing that. So it really fits in well to the whole ESG bit, and it's made us thinking about, in Trinidad, we still vent associated gas, or we've got fields. We run away from gas in Trinidad, small gas, but we're now thinking, well, can we do something with that? Can we turn that into CNG to fuel our vehicles, fuel our rigs? We spend many hundreds of thousands of US dollars a year on fuel. Again, that'll bring our operating costs down. Again, that'll bring our CO2 and particulate emissions down. And it's something we've really got to look at. So it's not just exciting, we're really moving forward. And our team have got to the point where actually they've scoped the world, and we think, because this is quite a modular set of technology. In fact, at the second page on the presentation, if I just pop back a second, you'll see we just put it near the this slide here, the second slide. It's just the indemnity slide, but that yellow gauge that sits on an oil tank is digitally measuring how full that oil tank is and sending the data by 4G to the office. We've got an independent power source there, so we keep the power nice and smooth for our wells. And the 4 men are at the power pack, the variable speed drive. That's where the software is that controls the speed. It takes the data from the well and controls the speed of the pump. And all that data goes back on the mobile network to town, where it's analyzed. And that's another skill having to develop is, this data comes in every 11 seconds, it's calibrating. So it's a really important part taking forward. And as Jeremy said, we've done a lot of it offshore and we've seen the benefits of that. So it's a differentiator as well when we're, in deep discussions with Heritage and others about new acreage and new business. And what very important it is that if you take on a new asset, you grow an asset, you drill more wells, you buy an asset, you're able to scale very quickly because you can automate it and you understand it, you understand the cost of it, and you understand the benefit of it. So it's there's no consultants here. This is being driven. The intellectual property of putting all this together, it belongs to Trinity. So it's a very interesting and exciting part of the business. I'll just move you forward, Jeremy, to your next slide. Okay, Jeremy.
Thanks, Bruce. As ever, I think we presented 2019 to some extent, and of course we'll field questions on that later on. We thought it would be useful to bring you up to speed with the sort of 4 months that have intervened since the end of the year, and we've got a few headlines here that we will discuss. And one is the production and realizations, and the production actually we rounded off Q4 19 at 31.96. And then Q1 of 2020 was 32.91, and then when you actually add April in, we 33.18. So you're saying that we did deploy some capex, we invested, we drilled 6 wells in Q3 and Q4 of last year. But what you typically tend to see in Trinidad is that there's a bit of flush production, and then the production source it drops off. We are seeing that we're managing to hold that production pretty tightly, and the 2019 wells that we drilled, those 6 wells are actually performing, very much on par. So we've seen production here that is holding pretty strong, and that's a testament to the operational capability of the guys on the ground. And notwithstanding, they have been unwavering in their response to get on and deliver the production in the midst of everything, which I am quite proud to be a part of in terms of the resilience that I've seen. In addition to that, the oil price where it is now means that SPT was not payable for Q1, and it's likely not to be payable for perhaps the next few quarters. And for those who are not aware of what SPT is a tax called supplementary petroleum tax that kicks in at just over $50 in terms of your realized price. It's calculated on a quarterly basis and is in essence a royalty because it's taken off of your net revenue. It does deteriorate economics as you head over 5001. And it's seen as a bit of an onerous tax, and a tax that is not quite widespread globally. So where we are right now, though, and what the forward curve looks like, it doesn't look like we'll actually be within that range for the foreseeable future. In terms of the operating break-even, Q1's operating break-even was $26.70. We intend to average this year at closer to $20.50, inclusive of hedging income, as I mentioned before. We are well on our way to achieving that. Certainly the management accounts for April are very conducive to achieving that. And I think the overall financial capability in terms of the discipline that we've shown in the past is still present within the team, and the operational discipline to follow that and still achieve the production is something that the board and management feel comfortable around. And this ensures, as we mentioned before, that we cash generative across from a low set of low oil prices upwards. Cash position is currently, since the year end, of course, we accreted cash at the end of Q1 at 14.2. We then drew down the facility as at the end of April, we had $60 million. So from a cash balance sheet perspective, the balance sheet is pretty strong. As I said, no senior debt on the balance sheet, and the working capital facility we have modeled in risk scenarios, that we, in a worst case, we have to repay that, and the business remains a going concern. So I think that from that perspective, we're pretty much in good stead. COVID-19, I'll probably start at a Trinidad level and then come down to Trinity. So Trinidad has seen quite a few cases, but the curve that we have has been relatively flat. So we've seen around 116 cases, and of those, 8 deaths have been recorded and hospitalized. All of these people have been hospitalized, but right now there's only 1 person who is currently hospitalized. The rest have either been discharged or in step-down facilities. And the 116 we've been seeing for probably about 2.5 weeks or so. So the curve has been relatively flat. On the back of that, the government advised that on Saturday gone here, that they will begin to remove layers of restrictions as they move through and try to get the economy back, back into full gear. But of course, very mindful that if the statistics change, that will they would quickly peel those back and put those restrictions on. From a wider perspective, there was an Oxford University study that was done in terms of looking at companies and their preparedness for the pandemic, and Trinidad actually ranked number 1 in that. So I think our statistics line up with what was, I guess, the outcomes of the study. And certainly in terms of Trinity to date, we are also correlating with those statistics in that, our operations have been unaffected so far, knock on wood, and we haven't had anybody within our team who has been suspected or even confirmed in terms of a case within any of our staff. So I think we've been quite fortunate there so far. Nonetheless, the management and the board continue to look at potential scenarios where that could have challenges around it, and we will try to manage, and we have plans in place that allow us to try to maneuver as best as we can. From an ESG perspective, Bruce touched on it a fair bit. By looking at what we are doing in terms of trying to be more efficient, it inevitably involves looking at the environmental and social governance aspect of things. Bruce mentioned, we measured our greenhouse gas emissions in 2017. We are a very small percentage of the national overall greenhouse gas contribution, but nonetheless, we think it's something that we can get better at and something that allows us to also focus and get our business more competitive, not just from the ESG framework, but also from a financial framework. As Bruce mentioned, there are areas where we can perhaps better utilize gas that is produced in association with the oil, and perhaps take that and utilize it to fuel our vehicles or utilize it for electricity. And these are areas that a recently formed ESG committee is looking into. So we are certainly contemplating it, and we see by exploring that arm and putting it into an execution mode, we'll also another area for us to differentiate ourselves from other operators within Trinidad. Moving on to the next slide. On this slide here, this slide points to the direction of travel, and it tries to illustrate what has been happening with Trinity, certainly from 2014 up to 2019. The top left-hand side, the red bit is production. So you can see production went down a bit, and then it flattened between 2016 to 2017. And that is when when it is that we sort of took hold of the business. There was a financial challenge that we were facing, and we restructured the business in 2017, and we started to invest. And at the end of 2018, you saw production growth, and that trend continued into 2019 and continues into Q1 of this year, and it continues into April. So the direction, the travel of production is very much encouraging to all of us within the company, and certainly we play a part as we contribute 6% of the overall national liquids. And if you actually remove the national oil company from that, we actually contribute 14% of national liquids. So that's something that we take that responsibility quite seriously. And underlying that and underpinning that, you can see the realized price somewhat trended along with the production, but a bit more deep in terms of 2015 and 2016. You can see that variance there. The oil price dropped out and then it stabilized and started to creep back up. And into 2018 and 2019, it stabilized, but the 2019 realization was slightly lower than 2018. But you can see that the green line below, you can see that the profitability on an adjusted EBITDA margin rose from 31 to 34%. So that is I think from looking at the perspective and seeing what is happening, you can see the business has been generating, being profitable from sort of 4% in 2015 and taking that up very rapidly to 19%, then into the 20s and into the 30s. Of course, we will be impacted by the oil price. But what this shows, if you look at 2018 and 2019, is that with a slightly lower realized oil price, but with increased production, we had the ability to actually increase our profitability, thereby proving that investment thesis when we came to market in 2018, that if we get more barrels across the bow, the marginal cost should be less, and we should be able to generate more profitability. So this is given credibility to that thesis. And the graphic below illustrates the break-even, and the break-even in 2014 was quite high. It started to come down in 2015, towards the back end of 2015 when changes were made. And then in 2016, it was sub 30. And for the past 4 years, it has been sub 30. And that's something that we take with us and ensures that, we were resilient. We are resilient. By no means we contemplated the scenario that is in front of us with the virus, nor its impact on demand for gasoline and jet fuel, etc. So that was not present. We didn't contemplate that at all. But it also meant that when we looked at the business, we weren't in the position of having to change a business model, but more a refinement of where we were. And the initial layer of costs that we have taken out have not impacted us negatively from a human resource perspective or impact production negatively in any way. So what does this all come together? It says that, we're resilient by design, of course, and we've described that to a certain extent. The innovation that we have, it underpins this, but also is going to deepen and concretize our position in terms of profitability, in terms of operating cash flow, increase the resilience of the business. And we certainly think that as the oil price moves up, there's the ability to leverage. We will have that ability to leverage, and it's clearly shown in the numbers here. And the numbers are not, one-off, 1 year. It's for the past 4 years we've been demonstrating this. And the direction of travel is to get even better, illustrate competitive advantage through automation, digitization, ESG, and through the substantial reserves that we have on and within our portfolio. We think, on the onshore, we have the room to grow production there as we have done, in a sort of gentle 10% every year on year, of course, oil price dependent. But certainly we have a transformational project in the East Coast by way of Project Echo, which is following on from the Teagal discovery, that on its own stands to contribute about 5,000 to 6,000 barrels based on the current project parameters. And again, coming back to national production being sort of between 55 to 60,000, that's a potential uplift in national production by 10%. So we see it as having national interest as well too, and that project continues to plow away in the background with very minimal spend, but with significant value being added on a very frequent basis. So I think all that comes together, and we put a few metrics down there below to illustrate. If you look at the typical analyst type metrics, we are trading at a very, very low premium, well, not a low premium, a massive discount rather. And that, we think that now is the opportunity to, one, as the oil price starts to rise, of course, we set to leverage that. But also we have a business model that is set for scalability and repeatability. I'll move on to the next slide and hand over to Bruce to wrap it up.
Yeah, thanks, Jeremy. Just to kind of repeat some of the key points, we have a very strong production base and balance sheet and a very strong model. The last oil company I did was very similar to this. And just speaking around to senior people in industry over the last few weeks, many of them are, I think, thinking, well, maybe in this new era, we should shift more towards production-driven businesses with infrastructure-led exploration, as we used to call it in the North Sea. So that's pretty much what our portfolio is. We have an absolute key focus on the health and safety and happiness of all our employees. They're an incredible bunch of men and women and are doing an amazing job. And I think, as we talked about, our ESG move, our automation move, they're all pretty motivated. Very good break-even target, as you said, for the year. And we can take it down further if need be, but we're keeping everybody whole right now. And we focus on base production like there is no tomorrow. I think other companies tend to drill new wells and focus on them, but base is fundamental. And we've done a great job in doing that. We've talked about a prudent approach to cash. Cash is everything. And, we have some very strong relationships in the City of London with our hedging that really help mitigate much of the volatility that we see in the market. Our capital projects are discretionary, if you like, right now. And, we are not returning to drilling right now. We will wait till the oil price firms substantially. We mentioned Teagal, which is the Echo platform off the East Coast. We haven't gone into a lot of detail here because this is really trying to focus on the shock that this industry is in and how we're going to get through it. But we have done a huge amount of work with a major supplier on the top sides, pipelines, electricity. We have a small piece of work to finish on the dynamic modeling on the reservoir. And we're in continuous discussions with the Ministry of Energy on license issues and with Heritage on their position as we take this forward. And we've already kicked off our 1-year environmental studies, so we can get a certificate of environmental clearance sort of February, March next year. So that is moving. Obviously, where the oil price is right now, you would not sanction a project, but as things improve, that will get closer and closer, and we will be able to talk about it with more and more clarity, particularly when the contractual side of it is cleaned up with the Ministry and Heritage. Automation, you've heard us talk a lot about it, and improving our ESG credentials. As you box yourself in, it creates opportunity. So we've got to go down the environmental and social governance route and be more responsible, but we have to generate a return. And I think our approach right now is pretty much looking good down that line. Heritage is still a very new company. It's still in transition. It's only really been running 15, 16 months. Unfortunately, the CEO had to stand down through illness, and we've got a new temporary one in place. So we're still working with them. We've got a very good working relationship with them. But of course, COVID's come along, and they're fighting fires like any other large oil company. So, but we have very good traction with them, and we're always looking at new opportunities. This, after all, is a business, and our responsibility is to our shareholders and all the stakeholders, and in Trinidad and here. So we're in good form. There is a storm going on, but we are focused on the basics to keep ourselves strong and steady. And we're pretty excited by the way we're automating the company and building new business. Thank you.
Many thanks, Bruce. Many thanks, Jeremy. Please continue to submit your questions using the Q&A tab on the right-hand side of your screen. But just while the company take a few moments just to review those investor questions submitted already, I'd like to just remind you that recording of this presentation, along with a copy of the slides and the published Q&A, will be accessible via Investor Meet Company dashboard on the Investor Meet Company platform. And lastly, before I hand back to the Trinity team, I'd like to remind you your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. If I can hand you over, I know it's not very long, guys, but if I can hand you back to the Trinity team just to have they had a moment to review some of the questions, just to pick a couple out to answer. We've got a few minutes left.
Yeah, sure. There's one question come in on opportunity to acquire distressed assets for companies not so well positioned. Probably better described any assets from distressed companies. Yes, but we're very focused in Trinidad on certain sweet spots for the type of business we've got. But yeah, we keep a very wary eye on that, and that's one of the main reasons we hold on to our cash, such that if an opportunity does come along and we have a willing seller, and there's a willing buyer-seller relationship, then we are in a position. But nothing has popped up yet, but we keep a wary eye on that.
Cheers. I've seen one, perhaps we may not be going in exact order, but the last one that's come in has asked about debt and what is the ratio of debt to equity by Cliff W. So Cliff, if you look at our 2019 year end, you'll see that there's no debt at all whatsoever on the balance sheet. Post the year end, we also, up to the end of Q1, had no debt. We had access to working capital facility with CIBC, and we drew down on that debt, which is $2.7 million. It's an on-demand revolving working capital facility. So it's not it's a short-term debt, not long-term, not senior debt. And that is all the debt that Trinity has. There's nothing further than that.
Colin asked a question about your deeply resilient low-cost producer. What is the case for share price growth post-COVID? You have a high turnover of common private shareholders. Where's the hope for loyal, longer-term holders who have remained and sit significant financial loss? Your response to shareholders and stakeholders, of course. I'm probably the longest suffering shareholder, but it's a very good question. I think, the world has changed over the last few months. I think people might be looking at slightly more conservative companies. If you go through the presentation pack deeper into it, you will see that we have done nothing but deliver production over the period from 2017 to now. It's a remarkable chart, and we continue to do that. Even this year, we'll be growing production without drilling any wells. So, and if you think where the oil price is now, and where relative share prices are, I would hope that people would look to invest in cash-producing companies that have good margins. And as the oil price, as we all think, well, it already has recovered somewhat, begins to rise, those companies with that margin should rise as well. This platform we're presenting on, we were looking at these prior to COVID, so I think you'll see us being a bit more out there and a bit more pushy than we have been in the past. But every quarter we deliver, and have done for a long time. So I would hope that any shareholder, longer term or short term, but being loyal, would stick with it. I remember at Venture, I raised my first money when it was $10 a barrel. It was close to impossible to raise money. And when we took that public, the share price went down fairly significantly. But as the oil price rose and we managed to grow the business concurrent to the oil price rising, it took off. So it is also an opportunity for us to grow the business. We know what we've got internally. We know what we've got off the East Coast, but there are other opportunities as well. So I would hope, in a slightly different world that we're in now, that this sort of business model might be more appealing. But thank you for your patience.
Thanks, Bruce. I've also seen a couple of questions around impairments, so I'll probably try and address the two questions I've seen with one answer. At the 2019 year end, there was an impairment of just shy of $15 million, and that is largely related to the price deck that Trinity took on. So I mentioned a tax earlier called supplementary petroleum tax, and that tax kicks in at just over 50.01. So the closer you are to 50.01 is the worse that it gets. And the price deck that we used actually looks at the average over the long term is around between $52 to $53. So we're very close to that spot. So that drove a significant amount of the impairment, if not the majority of it. And if you actually look through our accounts, you'll see that if you do sensitivities of 10% upwards or downwards, that impairment changes significantly as it improves, and the impairment is less. So it is oil price driven. It's also non-cash to note in terms of that's not a cash related impact in relation to impairment. And then in terms of future impairments, I guess when you take an impairment such as this, you reduce the probability that the PPE or the property, plant and equipment that you've written down is now reduced, and as a result, it reduces the potential for that to be written down further in future years. So as oil price goes up, or it stays within a certain range, given that you've written down a fair bit of your property, plant and equipment, the likelihood for further volatility in the financial statements, the P&L and the balance sheet respectively, is largely reduced. So whilst within there, that impairment that we took is large, and it is a relatively worst case scenario in terms of the SVT, I think the board and management were comfortable that it was a prudent approach to take at this point in time, and also that it reduces volatility in future years in relation to the financial statements.
Guys, thank you very much. And just conscious of time, thank you, Bruce. Thank you, Jeremy. There are a number of other questions, but the management will review those post the event, and they'll be posted back on the platform. So that concludes today's presentation. Please don't close the sessions. You will now automatically be directed for the opportunity to provide your feedback. If you access this meeting from our website, the feedback will appear directly in front of your screen. If you've accessed it from the link sent to you by email, you'll be asked to log in to submit your feedback. So once again, Bruce, Jeremy, thank you to the Trinity Exploration Production team. That concludes today's meeting.
Thank you.
Thank you. Thank you.